Good morning. I hope everybody is doing well. It's Wes Ashton from Harbourfront Wealth Management, Oakwater Wealth Council. Today, I'm going to be talking about what you should be considering as we head into the new year. A lot of folks focus on their personal health, but very few people focus on their financial health. So today, what I'm going to do is help you understand where you should be starting. And today, I'm going to cover off a self-assessment test that I do with a lot of our workshop attendees that we find is very helpful. Financial literacy in Canada is very poor. And unfortunately, most Canadians choose not to focus on their finances for a number of different reasons, whether they're overwhelmed, whether they're frustrated. So the self-assessment test will help you understand where you should be starting. That's the first or the most important thing, is to actually understand what you need to solve. So what I'm going to be doing today is I'll spend a few minutes actually just walking through a self-assessment test. So I'm going to pause for a quick second, go grab yourself a pen and paper, and we'll get to it in 1 second. So this exercise is actually going to be segmented into a couple of different categories. So we're going to focus on tax minimization, portfolio construction, income planning, trust and estate planning, and then I'll have a couple follow-up summary questions. And then for business owners, I don't want to leave you out. So we will actually spend just a couple moments asking a couple questions for you as well. So number one, I have a plan in place to convert taxable income into capital gains on an annual basis. And for this exercise, you want to answer either yes, no, and if you're not sure, just put an X. Number two, an RRSP is a tax deferral mechanism rather than a true tax savings strategy. You are taking full advantage of alternatives to RRSPs that provide similar annual tax savings without locking money in. Number three, I have a plan in place to withdraw from my RRSP or my RIF in a tax-efficient manner. Number four, I have analyzed my portfolio using asset allocation software to ensure my portfolio is as efficient as possible. So folks, what's really important right now is central banks are increasing interest rates, or they're planning to be increasing interest rates as a result of inflation. It's been a long time coming. And what we're seeing right now is we're starting to see some contractions in the markets. So I would challenge you to actually go out and actually understand, if the market does correct, 10, 15, 20%, what will my portfolio do? And if you haven't had a back-tested analysis, then it's very difficult for you to understand what the impact of a market correction or a market pullback will be to you and your family. Number five, I am familiar with standard deviation and know what the deviation of my portfolio is. Number six, I am using portfolio protection strategies or alternative investments similar to what the pension plans, charitable foundations, and endowments are currently utilizing. So I'll give you an example. So a lot of Canadians rush out, and to manage the risk of the portfolio, they actually introduce fixed income into their portfolio. Public bonds, company bonds, so on and so forth. The challenge is, as interest rates go up, these bond prices are going to fall. And a good example was last year when most bond indexes were down between 3 to 4%. So these alternative investments like the pension plans, the CPP as an example, they have shifted away from publicly traded bonds into private alternatives in real estate, debt, private equity, and they get consistent and predictable returns. Unfortunately, the average Canadian portfolio has less than 1% allocated to this asset class. So if you haven't heard of this before, this is something that you should be considering. Number seven, I have a retirement income analysis in place to ensure I am spending or planning to spend just the right amount during my retirement. A lack of income projection leads some to deplete assets too quickly, while others may not lead their preferred lifestyle due to uncertainty over whether or not money will last. So folks, planning is so critical throughout your various stages of life. Yet less than 50% of Canadians have a written financial plan. So it's really important that you actually put one in place. Number eight, when I retire, or if I am retired already, I know exactly which accounts to draw my money from in order to keep my tax lower. And this is the various accounts. These can include registered accounts, whether it's RRSPs, LIFs, etc., tax-free savings accounts, whether you should draw from one spouse's account prior to another individual's, corporate investments. This is critical as well. rental properties, corporations, etc. Number 9, I have an estate needs analysis in place that calculates the approximate estate taxes and probate fees that my estate will pay when I pass my assets on to the next generation. Okay, now we're also having a lot of conversations about gifting. So we have a lot of parents that have accumulated a significant net worth, and passing it to the next generation in an efficient manner while they're alive is important to them. Number 10, there is a plan in place to ensure assets I leave to my beneficiaries are protected from current and future spouses, other potential creditors. Number 11, my will, power of attorney, living will, and representation agreement have been reviewed in the last 3 years. I can't explain how important this is. We come across a lot of folks that have accumulated a significant amount of assets in their lifetime, but have yet to actually put a will or power of attorney in place. And unfortunately, I had a client years ago mention that every person in this province has a will. The difference is whether they've actually provided the proper direction or whether they're going to leave it to the courts to decide come estate time. So again, while we're healthy, while we're of good sound mind, these things aren't overly costly to put in place. However, if we wait and we need to put in an agreement like a power of attorney after the fact, it can become very cumbersome and very expensive. You know, in the neighborhood of thousands of dollars, $7,000, $8,000, $9,000, $10,000 to actually get that power of attorney in place after the fact if you're not in good mind. Number 12, I can honestly say that I'm taking advantage of all the tax reduction strategies currently available to me. Number 13, I am comfortable that my spouse and or children will be able to manage our family assets when I am no longer here. Number 14, I know the difference between a traditional investment advisor and an institution that provides an integrated approach to all my financial requirements. And my last 2 questions, and again, these are more for business owners. I have a plan in place beyond taking out dividends to access my corporation's retained tax earnings with little to no personal income tax. So are you taking advantage of the capital dividend account? And if you're not, what can you put in place to actually maximize those types of withdrawals? And I'll give you a really quick example. I came across a family recently who had a significant shareholder loan that was actually due to them that they were investing within the corporation. Unfortunately, passive tax rules in a corporation are very high. And in their case, they hadn't funded any tax-free savings accounts. So we were able to strip out close to $200,000 and invest, a large majority of that in a tax-free savings account that had no tax on a go-forward basis. Meanwhile, their current advisor was actually suggesting they leave it in the corporation. And in some cases, they were losing up to 50% of their gains. Okay? And number 16, I have a succession plan in place to either sell or pass my business in the most tax-efficient manner. So I'm going to pause right now. I'm going to actually have everybody just add up how many yeses they had. So 16 questions in total. So add them up, all the yeses, and any of the ones that you weren't sure, just leave those blank. So in my workshops, when I'm chatting to the attendees, we run through this exercise. And what I'll do is when we're done, I'll get everybody to add them up, just like what I've done for you. And I'll start to ask them, and I'll say to them, how many people here today had more than 12 yeses on their paper? Okay, and in your case, you're probably looking down and you're recognizing that that's not you. We may have 1 or 2 people in a room of over 100 that might have 12 or more yeses. Okay, then I ask how many people have 8 or more yeses, and you see a few more hands go up, but the majority of the individuals have not yet put their hand up. And I start getting people that kind of laugh a little bit because they recognize that they haven't addressed a lot of their financial concerns. And then I ask, hey, has anybody gotten 6 or more yeses? And a few more hands go up. But the large majority of folks that actually attend my workshops and do this exercise, I'd probably say 80 to 90% of the individuals have less than 6 yeses. Okay, and what that tells you is even though if you're working with a financial professional, often a number of these things are overlooked. Okay, so the question is, where do you go from here? That's the challenge, okay? So I'm going to talk about this really quickly and break it down on the type of advice that you can get here in Canada and what your next step should be, okay? Because often what happens is I run this exercise with a lot of folks. They recognize that they need to actually do something, but in large part, nobody does, okay? Your financial situation, your financial future is incredibly important, and getting on the right track is the first step, okay? So in Canada, there's roughly 4 different types of levels of advice that you can get, or different financial institutions. So number one is your traditional bank branch. And this is where most Canadians tend to invest their money because that's what they know. Bank branches are on roughly every corner. There's 6 large financial institutions in Canada. And most often, the advice that individuals get is to pay down a mortgage and make an RRSP contribution. There might be a little planning involved, but most often it's quite simplistic, unfortunately. And a number of these planning items are often overlooked. Well, once you graduate, once you have enough money, you typically go into their kind of financial planning division, or maybe you branch out and you go and you find somebody that actually is a financial planner. Well, financial planner is actually a little bit better than the bank because they do provide more planning, which is what a lot of Canadians need. But unfortunately, their investment securities are less, okay? And they tend to focus a lot on insurance-based investments or mutual funds or what have you. But to graduate from the financial planner, you tend to go to an investment broker. And an investment broker, they offer a wider array of investment products, stocks, ETFs. Some of them might have access to some alternative investments, but not very many. And they focus primarily on turning $1 into $2. So they focus heavily on the portfolio and they focus a little bit on the planning. Well, the next step up, and you don't see this on every street corner, and there's a reason for that, but it's the integrated net worth model. Okay. And this is where individuals dive deeply into the family situation, and they talk not only about portfolios, but they also do back-tested portfolio construction. They look for tax minimization strategies, which is critical. It's not just about getting a reasonable return, but it's what you keep in your pocket. They do income planning and projecting. I talked about it earlier, where the majority of Canadians do not have a financial plan or a retirement income audit. Folks, it's not just a matter of just doing some quick questions and forecasting, what your retirement will look like. You need to go through a process where you're having a discussion with a professional about how often you might travel. Do you have any lump sum expenses? Do you want to gift to the kids? What's your estate plans? Do you have charitable wishes? All of these various things need to be considered. And I can tell you, most often when I see a plan that comes across my desk that's been done at a different institution, that's overlooking a lot of items. And one of the biggest ones, as an example, is uninsured medical costs. Uninsured medical costs is going to be one of the largest expenses for Canadian retirees throughout their later stage of life. Yet most plans, most projections for families that come across my desk, there's no mention of uninsured medical costs. They simply pick a flat rate of what you're going to withdraw from your investments. They put a simple return on it, and they basically just say, hey, you're on track or not on track. So you need to work with individuals that actually know how to dig into your situation and understand what's important to you, and then help provide solutions to those individual items that are on your mind. Trust and estate preservation. So how many of you have a trust? Should you put a trust in place? For those of you that have a corporation, have you looked at potentially doing estate freezes? If your wish is to actually pass it on in the future. Another one that actually I've had quite a few conversations with, and it's very specific here in Canada, is what about second properties, rental properties, cabins, cottages, or what have you? How are you going to address the significant growth and future tax liability on that property? Should you be dealing with some of it today? Are you going to wait? All of these things should be included within your retirement income audit. On the business side, there's business and corporate planning and tax planning. Okay, again, I mentioned earlier about folks that are actually using the corporation, building assets, but they're not actually truly using it to their advantage. I mentioned earlier about tax or passive taxes within a corporation. Unfortunately, a lot of folks, they don't understand it, and they're not designing a portfolio to minimize those ongoing taxes to actually put more in their pocket. And again, lastly, the philanthropic planning and alternative investments. We have a lot of individuals that are wishing to reduce taxes and not have the government as their number one beneficiary. They'd like to pass it on to their kids or their beneficiaries. So there's some ways to get some tax breaks if you are wanting to make some charitable donations. And then the last piece, and I talked about alternative investments, private real estate, private debt, private equity. Again, most Canadians don't have this. And the reason why is they tend to subscribe to more traditional investments. And the drawback with this is, again, those more conservative investments are not doing well, and they should likely face headwinds going forward. So again, I'm not sure if this is suitable for you, but you should actually be having a conversation and saying, hey, should I be learning about this and introducing it into my situation? So those, again, are those 4 areas of planning within Canada. So again, I go back, say, hey, what's the next step? If it was me and my family, I would simply say, hey, why not get a second opinion? Is your financial future worth 15 to 20 minutes of your time? And in most cases, it absolutely is. Worst case is you get a free second opinion or a free opinion on your situation. You learn a few things and you go back to your existing situation and you implement some of those. But most often, those existing situations, those existing relationships, unfortunately, don't have the tools in place to actually be able to help you and help the family. So again, get out there and educate yourself would be my suggestion. So listen, I appreciate you taking time today and listening. If you like this, if you found this valuable, my suggestion, if you can just give it a like or subscribe, and more importantly, pass it along to a friend or family member. Get them to take the self-assessment test so they can understand if they're on track. And if not, what do they have to do to actually address some of these items and solve them? Have a great day. Take care.